Welcome to Illuminati Silver. We tell you the truth about silver. Today is Wednesday, the 30th of September 2020. And we're going to talk about the much maligned department known as the Financial Stability Team within the Federal Reserve. And who is the man who runs this entity? And what is he like? So stay tuned. Now, before we talk about the Financial Stability Division, earlier today we published a video entitled Market Response to First Presidential Election Debate, including gold and silver, where we highlighted that despite gold and silver rising on Monday and Tuesday, they both fell back a little following the first presidential debate between President Trump and former Vice President Joe Biden last night. We also reported that this morning the US dollar index strengthened above 94 and equity markets were expecting to open down while gold rested at $1,884 and silver at $23.66. The equity market futures were indicating in excess of a 200-point fall. Well, that was some 8 hours or so ago. Now, at the present time, which is 1812 GMT plus 1, the dollar index has fallen back below the 94 level and is currently 93.87. US stocks have reversed and are up 1.5% on average, and gold stands at $1,890, some $6 higher than this morning, but silver has fallen further by admittedly only another 10 cents, but to $23.56, but it has been seesawing throughout the course of the day. Now, if you haven't listened to this video podcast that we did earlier, we've listed it in the description box below and added it to the top of our comments, which we have pinned, and would suggest, hopefully, that you will listen to that. Now, the purpose of this video, though, is to read to you an article about a gentleman called Andreas Lehnert, who heads up the Financial Stability Team at the Federal Reserve. Now, for many, this man has a lot to answer for, or to, and frankly, has quite, to be fair, an onerous responsibility. Now, some of you may find this article interesting, some admittedly may not, but we believe it's important to begin to understand and to recognize the type of people who influence our policymakers' decisions, and how they actually go about that task. Now, we haven't solely written this article ourselves. We have taken it from Bloomberg Business Week's magazine, which arrived at our home office today. But the little we do know about this individual, it is, albeit slightly a positive article about him, it is a fair reflection on the man himself, or at least on the public man himself. So here goes. We shall go ahead with this article, and then when we finish, without having a further conclusion, we just ask if you have any comments to make, then kindly do so. And also, of course, as always, do not forget to subscribe to the channel and press the bell sign so that you're notified of our videos as and when they're published. So, here goes. The Fed's Disaster Junkie. Article published by Bloomberg Business Week magazine, week commencing September 28th. Headline: The Fed's Disaster Junkie. Andreas Lehnert reads up on airline crashes, plagues, and nuclear disasters to figure out where the next crisis could come from. A red alert sounded at the Federal Reserve in mid-March when Americans began pulling out of prime money market funds, one of the safest places to park cash. As policymakers cut interest rates to near zero, it quickly became clear that they'd need to get creative and fast to prevent a shutdown in the flow of credit. Fed Chair Jerome Powell and his board called on Andreas Lehnert and his 50-person team at the Division of Financial Stability Known as FS inside the Fed system, the division started in 2010 with a staff of just 4. The division spent much of the ensuing decade looking at fragilities in the financial system that could lead to a full-scale breakdown in moments of stress. So, when COVID-19 hit and widespread lockdowns of every type of business threatened a sudden halt in the flow of money, Lehnert and his colleagues were prepared. Chair Powell's instructions to us were that the system is going through a world historical crisis, so the response needed to be commensurate, said Lehnert. The marching orders were pretty crisp and clear, he says. Tried to avert permanent job losses as the economy went through a slide in activity before the eventual rebound. We sketched out what is every job that is out there, he says, and what would be a facility that would address those employers. Just 2 days after the Fed cut its benchmark rate, in a hastily convened Sunday meeting on March 15th, it rolled out the first of several lending programs that Lehnert and his colleagues had developed, drawing on blueprints from the 2008 crisis. By the end of the month, most of what would eventually total 9 separate facilities had been unveiled, providing backstops for everything from the corporate bond market to money market mutual funds to companies selling short-term securities to manage their cash flow. While some of the programs have had a slow start, nobody is suggesting that they're no longer needed. The plans were coordinated from a makeshift office Lehnert set up in his suburban Virginia home. Often fueled with oatmeal and almond butter and kept alert by means of caffeine, push-ups and hilly runs, the 51-year-old starts his workday around 7 a.m. and ends it late at night. The soundtrack from the musical Hamilton is usually playing somewhere in his house as he works. His wife reminds him to air out his room, which he likes to keep toasty. Lehnert's home bookshelf betrays his professional obsession with what could go wrong. He's read about why planes crash, why nuclear plant accidents run out of control, and why the Space Shuttle Challenger blew up. There's why buildings fall down, and plagues and peoples, perhaps especially pertinent for 2020. Lying for Money seems another useful read for someone in Lehnert's line of work. He says a common thread in disasters is that even experts can miss the totality of what's happening. They don't understand where they are when something goes wrong, he says. They had a bad process for understanding the behavior of the system as a whole. While Powell highlighted in a September 16th press briefing that the United States job market faces a long road to recovery, with 11 million Americans yet to regain jobs lost during the pandemic, the threat of a financial collapse has receded with the central bank's broad safety net. Now, some observers are looking for the seeds of the next crisis, all the more so since the Fed in August adopted a long-run strategy of letting inflation exceed its 2% target to make up for earlier undershooting, which implies that the central bank would allow the economy to run hot for a while. Fed officials on September the 16th projected they won't boost rates through 2023. Cheap money has a way of fueling speculation, excessive borrowing, along with amnesia about risks. The last expansion witnessed a Bitcoin bubble, a build-up of leveraged bets in the Treasury market, and a surge in high-risk corporate loans. Powell and the other members of the decision-making Federal Open Market Committee, known as the FOMC, are relying on Lehnert and the FS team to keep on top of potential dangers. Of course, we monitor financial conditions very carefully, Powell said in his September 16 remarks. We look at it through every perspective. The FOMC gets briefed on a quarterly basis. That briefing, known internally as the Quantitative Surveillance or QS report, comes from Lehnert and his team. It often focuses on special topics such as particular hedge fund strategies, potential weaknesses among mortgage service companies, vulnerabilities in structured loans, securities made up of repackaged debt, and the risk of disruption in bond trading. Because FS is relatively small, Lehnert relies on specialists from across the Fed system to help produce the QS. They are always looking to identify that transmission channel or amplification mechanism that we just haven't thought about, says Lehnert, the federal governor who oversees Lehnert and the FS crew, and who spends 90 minutes each day on calls with them. While the staff evaluations are never going to forecast the risks exactly right, the analysis is focused on that possible amplification of problems, she says. Lehnert draws on his voracious reading to help imagine what could happen. When he was a grammar school boy in Oklahoma, his parents inspected his backpack in the morning for books he might be sneaking out of the house that could distract him from his classwork. When that didn't work, they started locking up the books. One day they came home and found young Andreas reading the phone book. It was a magazine and its title that inspired his choice of career. His parents brought home an issue of The Economist when he was about 15. After reading it from cover to cover, he decided that's exactly what he wanted to become. He went on to earn a doctorate in economics at the University of Chicago, a school known for its faith in markets. He took classes from some of the world's most influential economic thinkers, including Nobel laureates Robert Lucas Jr., James Heckman, and Thomas Sargent. Lehnert also draws on his experience in the run-up to the last financial crisis, the unprecedented explosion in high-risk mortgage lending of the mid-2000s that almost brought down the global financial system. 7 years into his career at the Fed, Lehnert, in June 2005, was tapped to make a presentation to the FOMC on the housing market. One gauge of home prices had just risen 16% from the year before, even as the Fed started raising rates from historic lows. As many others concluded at the time, there was little systemic risk, he argued. Institutions with large amounts of mortgage credit risk on their portfolios are well positioned to handle severe losses, Lehnert said then. Neither borrowers nor lenders appear particularly shaky. Indeed, the evidence points in the opposite direction. Borrowers have large equity cushions. Interest-only mortgages are not an especially sinister development, and financial institutions are quite healthy. After a caveat, his bottom line was, the national mortgage system might bend, but will likely not break in the face of a large drop in house prices. That proved to be a failure to extrapolate the implications of a rapid evolution of the mortgage market and how securitization of low-quality loans could go on to threaten the financial system itself. We didn't understand the amplification mechanisms, Lehnert says now, noting that he often thinks of that 2005 episode. It is a muscle that we are exercising all the time now. He encourages his group, including Michael Kiley, who previously led the Fed's economic modelling team, Elizabeth Klee, an expert in the payment system, and the Chief of Staff, Naomi Mukasa, an investment banking veteran, to think beyond the standard framework of analysis. He calls the FS division a home for people that don't think just about what is in front of them. And he values thinking creatively about risks that we haven't seen or haven't worked in, rather than chasing the market move of the day or getting trapped into debates over whether there's a bubble in some asset. We have spent many years thinking about events that were unlikely, improbable, and frankly weird, says Lehnert. There was even a brief consideration of how a short, sharp recession caused by a pandemic would affect the US financial system. 99% of them never came to pass, he says, until one of them did. End of article. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.